Today, I've got to tell you about the American stealth tax. It's something that most retirees face. Many don't see it coming until it's too late. And what this is the fact that the way the laws are written in this country, the laws are written around income, not so much your net worth. And if you have a nice lifestyle you're looking to maintain, if you've got a lot of income coming in through pensions, royalties, etc., your income may be higher than you think in retirement. And your income dictates your Medicare premiums. I want to show you today how to keep your Medicare premiums at the bare minimum throughout retirement. Hey everybody, Chris Herland here, partner at Reap Financial. This channel exists to educate you about your life and your money so you can stay on top. If you like what you see here today, subscribe to the channel, give us a thumbs up below. So the American stealth tax. It's one of these things a lot of people may not see coming. And is it really a tax? That's the question. If you've done a good job of saving in this country, you may have to pay exponentially more for Medicare A, B, D, a supplemental. Depending on what you have, you could pay exponentially more than your next door neighbor because you maybe have a nice lifestyle you're wanting to maintain. Maybe you've got a lot of income coming in through pensions, royalty, real estate. But the way the laws are written in this country is around your income, not your net worth. And if you've tuned into this channel for any amount of time, you know how I want you. I want you to have millions in the bank, but be poor on paper. And the paper I'm talking about is your 1040. So when it comes to Medicare, if you're single in this country this year and you report over $91,000 income, if you're married and you report over $182,000 of income, that's when your Medicare is going to start going up. And there's 5 tiers, 5 income limits that can accelerate your premiums. And it's not just your B premiums, it's also your Medicare D premiums, your drug plan. So the way that this works is they're looking at, obviously, your income in retirement. Social Security counts towards that. Even for you savvy investors, muni bond, tax-free interest, muni bond income counts towards that. Your rental income. It's not just earned income. But a lot of families tell me, Chris, there's no way we're going to have over $182,000 in income in a year of retirement. Well, hold on a second. You may not today, but what happens when inflation and your cost of living goes up over the years? You're going to have to pull more money out of your retirement accounts. If it's IRA, 401k, it's all taxable as income. So that's one factor. The second factor is if you have to sell company stock. Maybe you have a brokerage account that's seen highly appreciated assets. Maybe you need to sell some of that in retirement. Maybe you're selling your highly appreciated home here in Central Texas, right? Capital gains count towards these thresholds, and this happens every year. Families will call, they're selling a house, and if you have capital event, and a lot of you do, what happens is that gain counts towards these income thresholds that I mentioned. And before you know it, you could be paying $300 a month per person for Medicare. And if you were to go to the very top tier, you could be paying well over $650 a month per person. So for a married couple, that could easily be over $15,000 more in a given year. Now, here's the best news. It's not irrevocable. So if you have 1 year or maybe a couple years of higher income, well, then in that case, once you get through another tax cycle, let's say your income has come back down to reality, you don't have any capital gains that year, well, at that point, you can go back down to Medicare and they'll bring your premium back down to reality. But here's the kicker. A lot of our families, many of you, have saved a fair amount in what's called 401ks or IRAs, 403bs, pre-tax accounts. You saved in those because we like tax deductions. And when you put money in those, traditionally you get it. And so if the bulk of your wealth is in IRAs and 401ks, what happens is as that money continues to grow throughout the years, when you turn 72, right here in 2022, the required distribution age is 72. And this is when, whether you want the money or not, Uncle Sam's going to come knocking and you have to take money out of your IRAs and former 401ks, whether you want it or not. And these dollars count as income. And as I mentioned, if you've saved a fair amount in these accounts, your RMD could be $40,000. It may be $65,000. It could be $125,000. We have clients with over $200,000 required distributions, and it's all income. So maybe you're in lower tax brackets along the way. Maybe you're in a 22% bracket from 62 to 72, and when your required distribution kicks in, boom, that extra $60,000, $100,000 plus income may accelerate your tax bracket. Now you're in a 24. Maybe you're in a 32. But it's not just taxes that are going to go up. It doesn't just mean you're giving more of your Social Security back. It means that your Medicare premium will be going up as well. And now you're starting to connect the dots on why I call it the American stealth tax, because they're means testing Medicare in this day and age, and they may do that to Social Security in years to come. But there are ways that you can reposition your portfolio to keep your required distributions down, to have the control you seek in retirement. So I want you to educate yourself. Get your hands on our brand new report right here for 2022. It's the Stealth Tax Report that talks about everything we've covered today and a lot more, and how you can better position yourself. Email me right now, retire@reapfinancial.com. That's retire@reapfinancial.com, and my team will have it on its way to your inbox. We'll catch you next time.